and welcome to today's edition of EnergySource Innovation Stream. Thank you for joining us. I am William Tobin, Assistant Director at the Atlantic Council Global Energy Center. I am truly pleased to be joined today by Shingai Samudzi, CEO and founder of Asoba, an innovative platform which leverages virtual power plants and AI-based electricity dispatch on microgrids to ensure reliable, clean electricity on the African continent. Shingai will be kind enough to provide us with an in-depth understanding of this platform today. But before I turn it over, I would like to say a few reminders. The first is that you can follow us on Twitter at AC Global Energy or via the hashtag AC Energy. Additionally, we are on the record and streaming on YouTube. We encourage you to ask questions, and you can submit them by going to askac.org and clicking on Energy Source Innovation Stream with Asoba. So without further delay, it is now my pleasure to turn it along to Shingai, who will provide us with an overview of his really exciting and innovative platform. So over to you. Thanks for being here.
Yeah, and thank you for the welcome. I'm looking forward to sharing what we're working on in South Africa and across the continent with everybody here. So I'm going to quickly share my screen. And go. I'd like to start by saying a little bit about Asoba and our mission. And I like to put it front and center. Ultimately, what we want to do is build Africa's largest private clean energy marketplace. We believe very deeply that energy is a source of economic growth and economic development. It is the fundamental root behind all of that. You can talk about infectious disease or gender equality, education, or many other important development topics. And not to minimize them, they are very important, but you cannot solve any of those problems without first solving the electricity problem. So that is our big aspiration, is that we have to solve that electricity problem first. Now, beyond just the energy discussion, there's also the discussion about climate change and this transition to renewable energy. And what I like to say is that we can tell the story of this renewable energy transition in just a few pictures. So this first picture is a picture of the market share, both extraction as well as processing, for both oil and natural gas, as well as selected minerals that are part of the renewable value chain. As you can see in the first set, the United States has a pretty meaningful share, both of the natural gas as well as oil. In fact, they are, if not the plurality, the majority market share across the value chain for both of those industries. The story is very different, though, when we get into the renewable space. It's an extremely different picture, where on one side it's much more multipolar in terms of the number of different participants who have meaningful market share. There are numerous more touch points on the value chain. But then when you get to the middle of the value chain, when it comes to sort of the semi-finished pieces of that, you start to see China start to take over pretty dramatically and take kind of that same role that the United States has within the fossil fuels value chain. And again, you can see when you break down the value chain into individual work streams or work items, you can see that picture of Chinese influence in clean tech even more starkly. Oil and gas, the United States has a very clear dominant market share. China has that similar picture when we look at clean tech. And then again, when I spoke at the very beginning, this relationship between energy use and economic growth, it is a very linear curve. There are no energy poor rich countries, and there are no rich countries that are energy poor. And so you can see Africa is at the bottom left of that quadrant, right? There needs to be a seismic shift in what happens. And that is where the growth potential is, because the mineral wealth is there. So we know that development can and will eventually happen. So what does that mean in terms of the shape of the world when that does start to emerge? And you can see a picture of that when it comes to specifically deployment of renewable energy, right? Where you see these failed systems of centralized generation, transmission, and distribution that rely on coal, oil, natural gas, et cetera. Whereas, Africa has, more than abundant sun, And as long as there's capital available to install systems, the CapEx requirements for a home system are very low. So you can start to see that we're seeing similar to the shift in skipping over the desktop generation in Africa, moving straight to mobile phones. We're seeing something very similar where on a continent where nearly half of the population does not have access to the grid, that their first touch point of access is not through these centralized, grids, but it's actually through a home installed renewable, solar geyser for heating their water, or solar inverter for electricity in the house. And then we also have this picture of who invests in China, or sorry, in Africa. And again, you've probably seen some version of this, where we look at DFIs, um, from China versus the United States and Africa. But I just want to circle this period of time, somewhere between 2015 and around 2021, where we saw essentially active divestment from Africa from the United States at a time when China was accelerating its own investment. Obviously, potentially cannot sustain this level of pace right now, but certainly the advantage that China has built from an infrastructure perspective. I mean, infrastructure wealth snowballs. So being able to catch up becomes imperative moving forward. And we do see a change in the amount of investment that's coming from the US, but it needs to be more. So there are three high-level takeaways, and I've been sort of peppering you with these this whole time. But one is that the American dominance of the financial system starts and ends with control over the fossil fuels value chain. So the second takeaway there is these net zero policies, which are also coming from the West, fundamentally ignore the geopolitical outcome or the geopolitical reality of banning fossil fuels. But more than that, they also promote a misallocation of capital because we're commoditizing carbon and we go down the path of things like carbon offsets instead of actually just investing in the highest returning uh, components of the this energy transition system, which is essentially investing in actual generation and transmission and distribution on the place where there's the greatest growth potential. And then that's my last point, really, which is like the investment in renewable transition should be happening primarily in Africa because that is where the bulk of the growth can happen. But not only that, that is also where a bulk of the minerals that are part of the value chain also reside. It becomes cheaper for everybody from across the value chain if we start doing much more of the intermediate processing in Africa as well as opposed to shipping out to China or shipping out to some other part of the world before moving it back and installing it in Africa again. So why is there energy poverty in Africa? Well, one of the biggest factors is that prices are largely subsidized by governments, which means that if you're a national utility, you are essentially forced into a structural deficit. And so as a result, you start to see lots of, in fact, decades worth of deferred maintenance. You start to see an inability to reinvest in new generation at a similar pace as the new demand comes in, or a similar pace as the decline of existing assets starts to set in. And as a result, you start to get a decline in large shortages of supply, and to the extent to which we see on the continent roughly 45 gigawatts worth of shortage. In South Africa alone, that's about 17 gigawatts, which for context, that's about 16 million households not having access to electricity at any given time if you were to if you were to stop the musical chairs of load shedding. And not only that, but you start to see nearly 80% of businesses across Africa deal with regular power outages, right? And so this is not just a challenge for households, but it also disrupts business. When it comes to industries, it means that you're not able to produce at the value expected from the investment that's put in. And what happens if assets underperform is investors don't follow on and invest there, and they become spooked from those markets. And what we're seeing is that there's a massive infrastructure and financing gap as a result of these bad experiences that investors might have. I think an interesting statistic is something like 85% of all infrastructure financing in the United States comes from private dollars, but only 12% from private dollars in Africa. So again, the Gulf, is a DFI Gulf, but it really is about private investment in that space. But we're starting to see a significant sea change in South Africa. Um, that is the most robust and mature sort of consumer market on the continent, and as a result, we saw a 300% year-over-year increase in the volume of rooftop solar capacity on the low voltage scale. And on top of that, we see a regulatory environment in which the government is actively encouraging and trying to attract private investment by deregulating the electricity market. So there's a really rich opportunity, but there's also a hazard um, that comes with that. So load shedding is very impactful. So load shedding is this series of cutting of power in South Africa um, and across the continent to deal with the mismatch of demand for electricity and the lack of supply. Um, as a result of this new private generation, we're starting to see more private trading. We're starting to see more peer-to-peer markets starting to come up. Um, but we're starting to see enough capacity in terms of people trying to net meter and sell back to the grid that demand management and demand response is now starting to become a pressing issue. And managing the duck curves and all those other issues that come with people supplying the grid are starting to come to the fore. And so we're starting to see some emerging themes. One of decentralization of grids, where more than just South Africa are seeing the solution to the problem of shortage is more generation, but also aggregation and distribution on the part of private entities of power, taking responsibility and cost off of the hands of national utilities. And as a result, we're also seeing those same mini grids or microgrids that are the source of generation becoming not just cost centers, but now financial assets that you can monetize with storage, and you can play arbitrage on the electricity markets. So with all these things in place, what we're seeing is that in South Africa in particular, but where South Africa goes, everybody else will follow, is that we see four needs that are present for a singular solution. One is that it can manage dispatch for distributed generation resources that are scattered all over the place and have different owners who are engaging in different market strategies. We need to be able to aggregate the excess power from customers that do have this on-site generation. We need to be able to support concurrent private trade of electricity at utility scale between power users. And we need to also be able to facilitate financing and development of last meter assets like smart meters and other transition storage infrastructure that's needed to ensure that the system is able to move all of the kilowatts that are available where they need to go. And so that's where the virtual power plant comes in, and that's where our particular approach to virtual power plants, which is a bottom-up solution to aggregation as opposed to the more traditional top-down approach, can come to the fore. Um, where we start with initial forecasting, we do basic dispatch decision making. We allow our customers to either manually implement those decision making, or we have devices that we can install that allow for automated dispatch or automated wheeling within the system. And as we sort of populate specific areas or specific municipalities, we can essentially layer on more meters and add more meters in scale to be able to build a system-wide model for a particular grid, whether it's a municipality or whether it's a particular service area or service region for Eskom as a whole. And this is an interesting model because it relies a lot on shared services or bundled services. We do not deal in the hardware. We're purely a software company, but we're software that relies on data being provided to us by the meters. It relies on data being provided to us by the utility companies. It relies on storage being available. There are a lot of different elements that need to be in place, and we become the nexus of this ecosystem. And this is an example of what the revenue model can look like with this kind of nexus system, where the pure electricity sales are distributed across a number of players, from smart meter owners to battery storage services to grid operators to Asoba to the actual generators themselves, or the power producers themselves. So you can see it's a very win-win-win business model that allows us to move into deals very quickly, not actually charge dollars up front. And in fact, we can install our software at no charge, and we simply take a percentage of the net revenue, the new net revenue that we generate as a result of more efficient, optimized electricity trades. And the way that it works, we have neural network models that do the training and then the deployment of our sort of forecasting inference models. And from there, we then generate dispatch decisions. We connect to microgrid controller hardware to be able to implement the actual wheeling decisions if we go that route. And we can also connect to electricity trading software via API. So we end up not only becoming the switchboard operator, but we're also a data broker within the system as well. Yeah, and the typical power producers that we work with, municipalities, mining companies, commercial agriculture, as well as national utilities. And we work at all voltage levels, from low voltage with small scale residential customers to high voltage, which are your large scale mining companies, utilities, et cetera. And then from a traction perspective, we've grown quite rapidly in the first year, with 180,000 in booked revenue last year. Expect about 3x revenue from that for this calendar year, and another $8 million just on the top of the funnel right now. And that's not including some of the anticipated pilots with a few national utilities, which we hope to be announcing publicly within the next few weeks. So there's some serious trajectory that we're seeing, particularly with national utilities, as they look to sort of onboard the IPPs that are trying to sell back to the grid in respective countries. And our deployment process is relatively quick, from the end of, or the signing of the contract to being able to deliver actual value to our customers is about 10 weeks, so just over 2 months. I mean, part of that is again, we're software. All we really need to do is connect to the smart meters, and we're already then able to start generating forecasting. And then it takes a few weeks for the models to train on the historical data and to actually start correcting themselves with actuals. But once we get to that point, then we're able to deliver value to our customer very, very rapidly. And then from the standpoint of sort of subject matter areas, we directly look at the electricity dispatch. We do supply demand modeling. We do price modeling for market development. We also help customers with energy deficit management. And we work with partners on the EPC side, on the actual O&M of the hardware assets. And then we can also support on the project development side as well, just depending on where there are needs in terms of financial feasibility or even grid impact assessments. And then from a key stakeholders perspective, we have partnerships across the board in the United States with heavy hitters like NVIDIA, Google, as well as U.S. government resources like Power Africa, with which we're a formal partner, as well as the U.S. Commercial Service, investment from Techstars, JP Morgan, Generator, and a slew of more local investors as well. And then again, from a team perspective, we have a lot of depth in terms of experience on the energy trading, on the deep tech side, the IoT side of energy, on the AI side. I think at heart, we are, an energy data and energy hardware sort of team of nerds, if you will, with the added aspect of financial expertise as well. And that really rounds out our ability to function both as sort of a grid management platform as well as an energy financial platform. So yeah, that's what we're doing in a nutshell. Really excited to share what we're doing in sort of the broader context of sort of the geopolitical challenge in Africa that we're looking to help address, and I'm looking forward to kind of diving into the Q&A.
Sure. Thank you so much, Shangi. That was really, truly fascinating. It's amazing how a platform like this is able to combine both the deployment of renewable clean electricity systems on the continent and then serve as a bridge with investors and incumbent actors on the continent in order to optimize the system and facilitate more investment. I think there's so many different pieces that go into how your system functions, and it's complex, I think it's fair to say, but it really is innovative. So I guess my question is, maybe for the benefit of our audience, if you could provide us with a bit more perspective on if there is a difference for your platform between investors and customers, like who might want to invest in a platform like this versus who might you be working with on the ground, and what is the relationship there that makes it all work? Thanks.
Yeah. I think In a world where there's more financial strength, there's a bit of an overlap between investors and customers. I think in the current state, though, the primary investors, are VCs on the U.S. side. There are, we saw J.P. Morgan in our cap table. So there are banks that also see the strategic value of, of being a captive finance, if you will, for projects down the line. And so they see the value in supporting a project and potentially looking at us as like an acquisition target down the line. I think in a similar vein, there are strategic investors like the EDFs or the Totals of the world. These international or multinational utility companies that are looking to monetize the the whaling situation in South Africa. They're looking to take advantage of their massive market expertise in utility scale generation, but they don't want to deal with the hassle of figuring out the business model of how that ecosystem is going to work because it's very complex, as you saw. And so they see us as sort of like the vanguard that can kind of clear out the initial roots and kind of clear out the soil to make it fertile for them to kind of move in when the market is much more mature. And so they're also a good sort of potential investor.
Great, thank you. And another thing I'd like to pick your brain on is how this platform, in your own words, can promote the better allocation of capital, which is something that you very astutely mentioned as being a major problem, of course, across the continent. There's an extremely large deficit in the sheer aggregate figure in infrastructure financing, as you mentioned, but also the source of the capital for that infrastructure financing, right, is generally not private, and thus the scalability is minimal, right? So in your own words, how would your platform better promote the allocation of scalable capital on the continent that can really build a healthier ecosystem for infrastructure finance?
So I think there are two components. So one is, our platform serves as a marketplace that allows for true price discovery for what the actual optimal price of electricity is at any given moment, right? Because not only are we the dispatcher, we also have, we will be the source of the best market data, sort of in the same vein that Uber is the best source of, market data around supply and demand for rideshare. We want to be the same for electricity within the markets that we operate. And so that pure price discovery and the enablement of asset owners or power producers to maximize their potential revenue and therefore maximize the asset value is a signal to investors that shows that when you invest in solar plus battery in Africa, right, your opportunity cost, if you're focused on clean energy, your opportunity cost is, 2 to 3% natural returns at best in solar in the United States, augmented by a tax equity strategy. But again, that's OpEx that you have to pay for. You have to pay for staff to kind of find those tax opportunities to keep on top of it. That becomes expensive and you start to lose money on the margins with that. Whereas, you could do that game, or you could look at something and say, without this arbitrage strategy, with just a pure 100% PPA strategy, you have, 12 to 16, 17% IRR on a 25 to 30-year, financing term. But then you throw in this ability to arbitrage where, if I'm a mine, instead of using 100% of what I generate to serve the on-site load, maybe I oversize the system and I use 70% of it for my on-site load and sell 30% of it. And now, my revenue potential and my return profile of this asset, instead of this, 12 to 16%, now it jumps up to like 18, 19, 20, low 20s, and that's in South Africa. You talk about what other risk is there from a financial perspective. You talk about de-risking projects, the same de-risking that you do if you're a solar developer trying to operate in the United States. Do I operate in California, or is it Texas, or is it Massachusetts? I look at the regulations. I look at the how do I net meter? How do I actually bill my tenants? How do I do all that kind of stuff? You de-risk the project to see where the returns are. You do the same thing in Africa, and you find that actually, even when you account for the perceived risk, et cetera, of Africa, which is not even true for most African countries, like South Africa, there are no terrorists, there's no, imminent coup or anything like that. It's a stable country, not well run, but it's a stable country, right? You see that the perceived risk is actually much higher than the actual risk. And so the returns versus the actual risk, you see there's an actually even greater arbitrage opportunity because of the perceived risk right now of Africa. So that's how the VPP sort of illuminates all of that, because again, it shows everybody exactly where the money is and what the opportunity is and how you can easily increase the asset value of any new solar you put in, which again incentivizes more investment in solar or renewables in general.
Beautiful, thank you. You actually answered my next question as well, which was to provide your perspective on the difference between real and perceived risks, the latter being, I think you might agree, often overblown, and the opportunities generally erroneously under-discussed, especially here in Washington. So it's really great to hear your perspective on that. Another interesting question, just to provide a little bit more depth to our viewers, how does your platform interact with, let's say, the national system operator, the grid operator in the environments where you operate? Are you a competitor? Are you an enabler to them? How would you describe the relationship with how the power system already works, how power is already wheeled, and what your platform can provide?
Yeah. No, there's no national utility that sees us as a threat, right? In fact, national utilities are trying to offload as much of load as they can onto private generators, because for them, serving, they only can serve, 30, 40, 50% of the population, outside of South Africa, which is, basically everybody. But for a lot of countries, they only can serve a fraction of the population. And again, they can't serve more, or they can't expand because of the cost that's associated with new generation capacity, building new infrastructure, and having to maintain all of that. So if they can offload that onto private sources, then they're happy to do that. And we're an enabler of that process. But beyond that, they also eagerly see us as a tool that they can use to help them themselves monetize the generation that they do have. Particularly in Southern Africa, where there's a robust power pool that the national utilities in the region all participate in. For countries like Zimbabwe, for example, which struggle with access to foreign currency, they can use those. They can use our platform as a way of generating extra revenue from the generation that they do have, that allows them to generate some extra cash. So again, they see us as a way of increasing revenue that's not available to them right now, just based on their inability to finance the infrastructure themselves.
Perfect. Thank you. And I think we're running short on time here. We have about a couple minutes left. So I'll close with one final lightning round question. And that's simply, what kind of policy support would best enable solutions like yours to scale and to enable the supply of that private sector capital on the continent? Again, that can multiply and build on itself to promote a good and thriving business environment, especially in clean energy. And I think I might also ensure that we capture under the umbrella of this question development finance institutions. So would love to hear your perspective on that to close us out.
Yeah, I mean, I think if we had members of the appropriation committee in this room, I think one thing that I would strongly suggest is layering in a tax strategy, essentially, to incentivize private investment in Africa, specifically in things like hydro, but also solar. I'm not as keen on wind, but I think sort of all hands on deck are essential. But the idea is, again, just addressing the perceived risk, which artificially increases the cost of capital, or the price, or the interest rate that the capital thinks about expecting from Africa. we make it expensive on the deployment side. So we just say, if you deploy in Africa in these particular spaces, we can alleviate some of that tax burden for when you repatriate your funds. And again, that helps sort of, you can kind of figure out what percentage the artificial sort of risk premium is. But I think that's one route for private capital. I think from a DFI perspective, certainly empowering groups like USAID, under that umbrella, Power Africa, specifically around investments in things like smart meters, because I think as powerful as our platform is, we are only as good as the data that we're able to receive, and it starts and ends at the metering, at the meter level. If we're able to get really accurate counts of the electrons that are generated and that are moved, then we're able to create meaningful, accurate forecasts that are sort of trained on a true precision and not just like precision on whatever data we throw at it. So I think that's specifically around the metering and the supportive infrastructure around that, I think is really critical. Same thing around microgrid controllers. So again, that's the wheeling or the dispatch portion. So being able to actually settle that, I think is also going to be really important. Just really all the supportive hardware, essentially, to make virtual dispatching a reality, I think is essentially where the DFI funding would need to really be concentrated, in my opinion.
Okay, great. Well, we appreciate your perspective, and we really appreciate your time today. This marks the end of our time together, but it was really fascinating to hear about your platform. And thank you for sharing so many vivid details about the investment climate on the continent and how the private sector can better seize on the opportunities which are present. To close, I'd like to thank our audience in addition, and I'd like to flag an additional event that we have forthcoming. This Thursday at 4:30 p.m. Eastern Time, we'll be having an event on reinforcing the Transatlantic Alliance through climate and energy cooperation. I would encourage our audience to tune in. And with that, thank you all so very much for joining us today. And Shangi, we look forward to staying in touch.
Thank you.
Thank you.